Let's get in Peter McGuire, who joins us in our studios to talk to us about the outlook on crude, the big OPEC meeting that's lined up, of course, what the S&P rating means for India, and more importantly, he's also got some details on what that Carmichael mine in Australia could mean for Adani Group stocks. Peter, let's start with the big focus point this morning. What brings you to India? Well, it's that big OPEC meeting that you're headed to this week. What are we expecting? What's the kind of impact that's going to have on crude prices that have been on a strong footing in the last couple of months? Status quo or more price or more production cuts expected?
Well, good morning and thanks for inviting me on the show. I think a couple of things. First off, it's been a very, very solid uptick over the last, say, 8 weeks or 10 weeks for crude. We've seen US dollar rally strongly to that 94.5 for the US dollar index. It's come off and now have the Brent market 63, 64 with probably even more momentum, and WTI at that $58 level. So it's been a bit of a surprise. I think there's also the other side, of course, is that Aramco IPO in 2018. So it's been a nice...
We've been talking about this for a while.
Well, we have been, and I think, you know, it's probably the largest IPO in history. So valuation, what's Aramco worth? Is it a $2 trillion stock? I don't know, but it's very, very interesting, and there's been that continued uptick. So it's going to be jury out on Thursday, but I think they'll have an extension on these production cuts.
Right, Peter, every factor you've mentioned seems to be very short-term in nature. So the dollar play, or be it the Aramco listing, or now more recently, you've got that US pipeline that has been closed for a bit now.
Exactly.
All of that is providing support to crude prices. But how sustainable is that? Because at the end of the day, these positive factors will start weaning off. It's only a matter of time.
Well, exactly. I mean, it's cyclical. You've had the hedge funds also really, you know, the largest positions in their history as far as open futures. So all of those components, I think, are just going to the melting pot as far as price. And at the present time, there's just a push up. I'm not sure how far it'll go, as Brent got the capacity to take 70 out. I mean, who would have thought that, you know, you'd have WTI pressing forward now nearly at $60 a barrel. If you put your mind back to mid-year, a lot of traders probably saying, well, it may not even hit 50. So it's been a surprise. It certainly has momentum, and let's just see what happens on Thursday.
Peter, in terms of, I'll take a question. Peter, in terms of expectation, I believe the OPEC production cuts deal expires in March 2018. The general sense, like you indicated, is that there would be an extension to that. In terms of timeline, how much longer do you think these extensions could be put in place?
I wouldn't be surprised for a 3-month, take it out to June 30. The reasoning is that you'll have your next OPEC meeting, the major meeting, I think about the 27th or 28th of May next year. So those two large meetings, that's when the majority of the big decisions are made, and that's why I think probably an extension of 3 months. Let's see what happens as far as pricing over that period of time, what happens as far as US shale, where does the US dollar play, and if crude continues at these sort of levels and it moves higher, then there's going to be a lot of very, very happy producers out there.
Peter, that's, I think, on the similar lines I wanted to ask you. You have a lot of moving parts here in the next 1 month. On one side, whether the interest rates in US, they are going to increase or not. Dollar index has been weakening consistently over the last few weeks. So perhaps, will that interest rate increase, if it happens, it's going to support the dollar? And actually, can that actually be a lever factor for the crude price to finally start cooling off? On another side, there has been no major uptake in terms of the drilling rigs in US, actually. The production has been going up, but the drilling rigs...
I'm going to come in on that one, because I believe last week they have actually added oil
yes,
rigs, and the number
uptake
now stands to 747. So
in that context, overall context, actually, do you believe that the crude prices, they actually, at present, with respect to the amount of hedge fund positions we actually are seeing, they actually have a much higher risk now actually of going down?
Okay, a couple of quick things. First off, let's see what Yellen does. If we do see an uptick, you're going to see, as far as interest rates, we're going to see a stronger US dollar as far as the US index. So that'll be short term, but certainly over the, say, 3 to 6 weeks. Secondly, if the OPEC cuts don't go ahead, what impact that's going to have is going to be a stampede, I think, as far as probably prices will go down $3 or $4 very, very quickly, if not further. So a lot hinges on Thursday's decision. The next part of it is that, in going back to the miners, the Baker Hughes and all of the rig count, naturally as prices edge higher, you're going to see more producers come into the market as far as shale, because it just allows them to get a better return on their investment. And there's certainly, probably go back to that 800, 900 as far as crude numbers for those shale producers. So rig counts, that'll increase. I think there's just so many components out there that go into the mix to try and determine what happens. But fundamentally, I think Saudis and possibly the Russians will extend this cut.
Peter, of course, there's plenty of room for disappointment, right? Should the outcome of the next OPEC meet fall short of expectations, the large net long speculative positions on oil futures, do you think those potentially could see heavy unwinding, which could then drive prices lower the next couple of days?
Yep. Going back 18 months ago when we saw that meeting in Vienna in May of last year, you saw there was some talk there, what's happening as far as markets. Then you looked at what happened last November with the other meeting. The market comes off very, very quickly. Yeah. And I think that would be a very large stampede as far as, closing positions and going the other side, and just you may see a $3 or $4 or $5 wipeout very, very quickly.
So at this level, at these prices on crude, what is your trading call? What's your trading position? Would you be taking profits off the table? Would you go short on crude?
I think a trader would have to see what happens on Thursday itself. I think over the next couple of days, unless you see something dramatic happen as far as the geopolitical, I think prices will probably consolidate at this sort of level. Thursday is going to be a very, very wild day. There's too many outliers that could really impact price, and I don't think it's going to ratchet up quickly by 3 or 4%, but I think it could wash out by 3 or 4% very quickly if something doesn't happen.
I want to bring in another global factor here, and this is not about crude, but this is about the bond market pain in China that we've been seeing. How is that looking to you? Because those markets have run up so substantially, but there are some serious concerns now coming back to the bond markets in China. How much of this is on expected lines? How much of this has caught you by surprise? Could this be the start of the end of a very strong rally global equity markets have seen? Well,
it could be. I mean, the press that I read and the analyst views, certainly you might see that tail off, and you could see a consolidation and a push further down. There is just so many uncertain factors across that whole China situation, and I'm pretty sure that the way that China positions itself at the moment, it may not want to see any massive wipeouts. We've got, as far as the real estate sector, you've got what's happening as far as inflation, as far as growth numbers, all of those considerations. China has got two hands very much on the wheel, and I think that it's not going to allow itself to be heavily sold off or to have any large impacts to its market. It's such a global dominating powerhouse that I think that it's a little bit like QE in the sense of the States going back to 09 and 10. China's going to have the same capacity to make sure that we don't see any major sell-offs. Okay. They're worried about real estate prices. They know the speculation of those markets. So I think that the government will have to take a very solid stance on things.
Right, Peter. And also on those lines, again, basically, we have seen that what has been happening in terms of sterling, euro, again, those actually have seen a sharp increase versus the weakening of dollar index, US dollar broadly. And then again, if I link that to the commodities also, there has been some uptick in the commodity prices. Like after a sort of small moderate correction, we have seen the commodity actually prices, base metals in particular, they actually have started coming back. Gold, silver again basically has been largely range bound, but still actually holding out. So now in that context, basically, do you see a very strong outperformance, chances of very strong outperformance by euro, by sterling versus the dollar over the next 1 or 2 months?
Let's see what happens as far as Janet Yellen. If the Fed chairman doesn't raise rates, then I think you're going to see a further softness as far as that US dollar index. Then you'll see, naturally, as the US dollar comes down, you'll see those other currencies appreciate. And that's, I think, the jury's out. We're waiting to see what happens. And it has to happen within the next 2 to 2.5 weeks.
My follow-up question would be that a lot of high probability is already built in. If we take a look at the Fed fund futures,
of course,
that's telling us that actually the market is expecting that the interest rate should be increased. So do you believe that a significant uptick in the dollar index could also happen, could actually happen if the rate increase actually happens?
I wouldn't be surprised to see a 93 handle, 93.5, well off its 94.5 that we saw going back to the start of mid-October, late October. The market's come off fairly heavily since that period. In the last, say, 3 to 4 weeks, it's been well sold off. So, I think as the anticipation of what's going to happen from the Fed. There's a lot of uncertainty there, and inflation is the great challenge to the greater market. We just can't lift it. So is the Fed prepared to see a rate rise? I don't think you're going to see too many in 2018. And again, there's just a lot of nervousness. If Janet Yellen doesn't increase over the next 2 to 3 weeks, when in 2018 are we going to see a rate rise?
And we also have Jerome Powell in the hot seat this week,
Exactly.
right? So that's going to be important. Not much is expected on that front, but I guess senators will get a chance to suss out his thinking. Peter, Europe had started catching a lot of attention in terms of positive news flow the last couple of months. Suddenly, the setup is looking a little more disturbing. So you've got a political impasse in Germany. You've got the UK, of course, that's struggling with Brexit. Data points are not looking as promising. You've got to see some unwinding as early as January in 2018. You know, putting those pieces of the puzzle together, what is the call on the euro against the dollar, and also what's the call on European equities?
I think euro-dollar is such a... it's a trader's paradise.
Yeah.
And when you're looking at the volatility, I mean, you know, you're looking... those large swings are really what a trader's after. They want movement. And we see that on our trading desks as far as the retail land globally. Not unusual. I think you possibly see a further unwind as far as that euro. But again, what happens as far as US dollar interest rate? And if you don't, it keeps on getting back to that argument, and maybe there's another part of it, that they don't want to do anything until Powell is actually in. Okay. So Janet Yellen just nicely sails into the sunset, leave it to someone else's problem. Yeah. And as far as euro and eurozone, there's a lot of still uncertainty. The mid-year euro was really on that turnaround, and possibly at the present time there's a little bit of wind taken out of its sails. So it's possibly over this winter period there could be a sense of consolidation and a further softening.
So just wait for the Fed to take the lead and then decide
I think so.
what needs to be done.
The eurozone. Exactly. The euro is, they've been a mover pretty much all year, and it's just a wait and see. Yeah, exactly right.
Peter, talk about the dollar-rupee pair. Last week we had an upgrade coming from Moody's after nearly 14 years. S&P followed, and they did not upgrade India, but they maintained status quo on the outlook for India, stating, of course, high levels of debt, sizable fiscal deficit, low per capita income. But they've also said that the economy is expected to grow very strongly over 2018 and 2020. And that, of course, was one of the key positives that came out of that commentary. How much of this, I mean, I'm assuming there will be a knee-jerk reaction of this on the Indian equity market, but in terms of the dollar-rupee pair, do you think this could have any sort of substantial impact in terms of the currency?
I think it's going to be a 63, 66 trade. Okay. There's going to be volatility.
That's a pretty large range on the dollar. It is,
well, it is, but when you think of what the Aussie dollar's done, if you look at that in the sense, we've gone from $1.10 to 70 cents. So there's, you know, there's, I think in a lot of ways, the Indian rupee is nearly pegged to the US dollar. There just doesn't seem to be a lot of price swing, and even those small percentage moves, it's not a wild, you know, Canadian dollar versus US, or it's not a really wild trade like a Japanese yen versus Swiss franc or something like that. So there's just that, at the present time, I think it'll probably stay at those sort of levels. Fundamentally, if you look at the big picture, the 2017, 2018 to 2020, those numbers are going to be outstanding, and that will only continue, I think, in the next decade. So fundamentally, it's growing now. India is just on one-way target as far as growth, and it's going to be an exciting place to see, you know, by the end of the 2020s, what this whole economy turns into, and it's really on a growth phase. Do
you track the governor's moves closely? So we've got the MPC meeting this week where the RBI will take a call on the rates in India. Of course, inflation is a worry. We've got GDP as well expected on Thursday. How closely have you been tracking our interest rate cycle?
I really don't, Samina. I mean, you know, I have a look at it, but I don't give it a lot of study. Simply, there's that many markets to look at. But I think,
and it's not a currency pair that gives you too much opportunity anyway.
No, well, it doesn't. That's a bit of a shame in that regard. But from a trader's perspective, but from a currency and from a country's viewpoint, I think stability is not a bad place to be.
And that's what the RBI likes, right? So at any point when you see the currency moving very, very sharp in either direction, there is some level of intervention that does
Yes.
take place. Also, this is focused largely because you have a grip of news flow and you know what's going on in Australia much better than most of us do. We've heard this morning that there could be a blow to the Adani Group companies as the coal mine plans in Australia, Labour Party, the Labour National Party, which is set to win the local elections in Queensland, was actually opposing the Carmichael mines.
Yes.
This has come as a bit of a surprise because, like you said, this party was not expected to win state elections. What could this mean for Adani and Adani's coal mine?
To speculate, it's certainly not a good thing. It's not the news that they probably wanted to hear, and with new parties coming into play, what their agenda is going to be, not only statewide, but the Labor Party is gaining momentum nationally in all of its states. There's a few states that are still Liberal, but they seem to be getting a bit of a groundswell, and we'll probably have a federal election in the not too distant future as well.
Okay.
So as far as the conjecture, and there's a lot of, I think, nervousness as far as Adani and what's happening in Queensland. From that coal side, and that level of uncertainty is not going to be a really green light for a lot of those traders, and of course for the company itself.
Peter, but I guess you have a sense of how difficult it might be to work around a political party in Australia, assuming that they come into power in Queensland and then, of course, win elections further down the line. Could this mean the end of Adani Group's coal mine plans in Australia, or there will be room to navigate? I'm just trying to understand how strict the policy making or the opposition could be here.
I think it'll navigate, and naturally there's no deal that you'll work it through, but there may be changes. They may be large fundamental changes, and until I think the only thing that can happen is time will tell, and it won't happen quickly. Now with a change of government, there'll be new agendas, there'll be new deal makers put to play, and the social impacts, what we're worrying about as far as jobs, all of those frameworks need to be considered, and I think it's just going to add more confusion to the particular opportunity.